Section 7. Unit 4, Seller Financing. Introduction and Objectives. Lesson 1, When a seller is willing to finance. Lesson 2, The contract for deed, caution required. Lesson 3, Seller Financing Alternatives. Buy-down is seller financing alternative. If a buyer is having trouble qualifying for a loan, or a seller simply wants to provide incentive for a sale, one alternative to carrying a second loan is to buy down the interest rate for the buyer's senior loan. A buy-down is essentially a lump sum cash prepayment of interest to the lender at closing to buy an interest rate down. This has the advantage of making the borrower's monthly payments lower and more affordable, as well as increasing the lender's yield. Because the loan is more affordable, the buyer is more likely to meet the lender's qualification standards. The advantage of a buy-down over an adjustable rate mortgage or a payment option that allows for negative amortization is that the mortgage payment always includes principal and interest, reducing the loan balance over time. Although buy-downs are most commonly temporary, lasting only for the first year to 3 years, interest rates can be bought down permanently, for the life of the loan. A permanent buy-down is reflected in the interest rate stated on the note. The cost to the seller for a buy-down will depend on market conditions and the lender. As a general rule, to buy the interest rate down permanently by 1 point will cost the seller approximately 6 points. For example, if the loan is for $200,000, that would amount to $12,000, 6%, paid by the seller to the lender to permanently reduce the borrower's interest rate by 1%. If the seller chooses a temporary buy-down, it would cost a bit less. This is a more common buy-down, and results in either a level interest rate reduction for a specific length of time, or a graduated increase in the interest rate over a period of time until it reaches the rate stated in the borrower's note. These are called 3-to-1, the interest rate increases 1% every year for the first 3 years, or 2-to-1, the interest rate increases 1% every year for the first 2 years, buy-downs. How do lenders calculate the buy-down cost? Let's use a 3-to-1 buy-down as an example. In this situation, the buyer is purchasing a temporary, 3-year, buy-down. If the standard interest rate is 4.5%, the lender may determine that the buy-down rates will be 3% the first year, 3.5% the second year, and 4% the third year. The interest rate for the remaining years on the loan will be 4.5%. To calculate the buy-down's cost, the lender will determine the difference between how much interest the borrower would pay at the regular rate and how much the borrower will pay at the reduced rate for each year. Those amounts added together are equal to the buy-down cost to the buyer. Example. Sandra is doing a 3-2-1 buy-down for her loan. Her lender calculates that, due to the lowered interest rates for the first 3 years of her loan, she'll save $10,000 the first year, $8,000 the second year, and $6,000 the third year. So, Sandra pays $10,000 plus $8,000 plus $6,000, or $24,000, up front at closing as her buy-down. Using a contract for deed. When sellers choose to finance all or part of a real estate purchase for a buyer, the contract for deed can be a powerful way to protect their interests. The seller/vendor retains the deed for the property until the buyer has completely paid off the loan. The buyer/vendee receives an equitable title in the property and the right to possess the property, but the vendor retains the legal title. The advantage of a contract for deed for a buyer is the ability to purchase a property even if an institutional lender won't give the buyer a loan. There's also more room for negotiation of the interest rate, terms, and down payment, and the cost of obtaining the loan may be lower. The advantage for the seller is the ability to find more potential buyers since the pool is not limited to those who qualify for an institutional loan, and more flexibility setting terms of the sale. In contrast to a mortgage or deed of trust, the contract for deed gives the seller the ability to more easily repossess the property if the buyer defaults. Because the seller holds legal title, the vendor, in most states, doesn't have to bother with foreclosure. Instead, the vendor can cancel the contract and take possession of the property. The buyer forfeits everything already paid for the property, and the vendor keeps both the property and all payments previously made. Of course, this is a situation that can easily be abused. Say the buyer has faithfully made all the contractually agreed payments according to the agreement. Then the buyer is in a car accident and misses a payment. The vendor could use that as an excuse to cancel the contract, reclaim the property, and start all over again with a new buyer. Courts have recognized that this is a danger of these situations, so some states have laws in place that protect a buyer's rights when a contract for deed is used in a sale. Another area of risk is that the property could become encumbered by new liens. These might be voluntary on the part of the vendor, who has legal title, or involuntary on the part of the vendee. For example, if the vendee hires a contractor to improve the buildings on the property and then doesn't pay, the contractor can put a mechanic's lien on the property title. In some ways, the contract for deed may sound more like a rent-to-own situation than a purchase. The difference is that the buyer is responsible for maintaining the property, including paying property taxes and insurance. If the vendee chooses, he can sell his interest in the property, as can the vendor, depending, once again, on state law. The contract may prohibit this or may require the other party's consent. However, the vendee can't use the property as collateral for any other loan, since the vendor holds the legal title. The vendee also doesn't hold as much power if the vendor chooses not to abide by the terms of the contract, other than to sue for breach of contract. There are no statutory requirements or restrictions with a contract for deed like there are for a note with mortgage or a note with deed of trust. Most of the time, the contract is structured so that the vendee makes regular payments for a few years and then is required to make a balloon payment for the remaining principal. The idea is that the buyer who was unable to qualify for conventional financing has now established a better credit history and can qualify for an institutional mortgage to cover the amount of the balloon payment. If that doesn't happen, the vendor and vendee are free to renegotiate their contract, or the vendor could decide to cancel it. For all of these reasons and more, the contract should be drawn up by a competent attorney so that it includes language that protects both the buyer's and the seller's rights. Although the contract for deed can be used as part of a wraparound loan where existing financing is already in place, it's most powerful when the property being financed is unencumbered. This allows the seller and buyer to create the financing agreement according to their specific needs, without the involvement of an institutional lender that has a lien on the property. Seller financing options. Sometimes a buyer will have difficulty obtaining financing, either because they don't meet institutional requirements, or the property doesn't. In such cases, a seller may be willing to provide financing in order to make the sale. There are three basic options the seller can use. Finance the entire purchase, minus an agreed-upon down payment, using a mortgage, deed of trust, or contract for deed. Supplement a conventional first mortgage or deed of trust with a second loan if the buyer doesn't have enough cash for the 20% down payment. This second can take the form of a mortgage or a deed of trust. The institutional lender will need to agree to the loan, and typically will not agree to a second loan where the seller is using a contract for deed as the instrument. Because the seller holds the legal title with a contract for deed, the lender would be unable to place a lien on the borrower's property. Therefore, the lender will require a mortgage or deed of trust as the security instrument for the seller's second. Create a wraparound loan where the seller keeps a current mortgage but extends credit to the buyer with a separate mortgage, deed of trust, or contract for deed. The second loan covers both the amount due on the existing mortgage plus the balance remaining to meet the purchase price, minus any down payment. The new buyer pays the seller each month to cover both payments, and the seller continues to pay on the original loan. In most cases of seller financing, the seller is extending credit to the buyer rather than giving the buyer cash as a loan. The choice of a mortgage or deed of trust is usually related to the foreclosure laws in the state. Most sellers will prefer the option of a non-judicial foreclosure if the borrower defaults. A seller who offers financing will want to evaluate the buyer's ability to repay, financial history, and credit score, but isn't bound by the same requirements as an institutional lender. States may have specific laws related to seller financing of real estate. If the seller is supplementing a buyer's conventional loan with a second loan, the conventional lender will require that the seller's loan meet certain criteria, such as not exceeding a maximum total loan-to-value ratio when both loans are combined. Some buyers and sellers make the arrangement for this supplementary loan without notifying the institutional lender, and complete the arrangements after closing. This is not mortgage fraud, provided the borrower qualifies for the loan from the lender. Seller financing, whether it's a first or second loan, and whether it uses a mortgage or a deed of trust, is sometimes called a purchase money loan. Another term used is the carryback loan, which usually refers to a second loan that supplements an institutional loan.